70% of DIY retail investors lose money. Not only do they fail to make a profit, they actively lose money in the stock market, but you don't have to be one of them. These are the top 10 mistakes that beginner investors make and how you can avoid them. Welcome into this video, guys. My name is Joe from Financially Savvy, and in this video I want to go over the main mistakes made by retail investors and how you can avoid them so you can avoid becoming another statistic, because the statistics are grim. The fact is, most people lose money in the stock market because they are using it wrong. Basically, they just want to make a quick buck, and some guru online told them they could if they bought this random penny stock or, bought the dip on some piece of crap business. And this is not how you build wealth in the stock market. I've now helped over 150 people get started on their investing journey via my stock group, so I've seen it all, right? The bad, the ugly, and the downright terrible. So I've essentially taken everything I've learned from this experience of coaching these individuals and put together a comprehensive list of the 10 most common mistakes that beginner investors make so that you can avoid them and avoid becoming another statistic. Let's get into it. One of my favorite investing quotes comes from the legend himself, Peter Lynch, who said, "To become a great investor, you need to understand how bad investors think." And I love this analogy because when you think about it, you can apply it to pretty much every walk of life in business or finance, whatever it is, and it's still true. Once you know what the people who suck at that thing do, you know what to avoid doing, right? So without further ado, let's go in with number 10. Number 10 is simply a lack of clear goals. This is where it all begins, and unfortunately, it's where most people fail. Because you need to know why you're investing in the first place. From your goal, you determine your time horizon, your risk appetite, and your overall investing strategy as a result. So think long and hard about it and write down your goals and your investing strategy that you're going to use to achieve that goal. That way you can refer to this with every move you make and check that the decision you're about to make is actually aligned with your goals and your strategy. If it's not, don't make it, because it means you're probably acting on emotion. Number 9 is trying to time the market. Man, if you haven't tried this yet, you are in the minority. Every single new investor at some point very early in their journey realizes that nobody can time the market or predict what it is going to do from day to day, week to week, or even year to year. And studies have shown time and time again that even if you could predict the exact start and the exact end of every recession in history, dollar cost averaging, or DCA, would beat buying the dip and timing every single time. If you're unsure what DCA or dollar cost averaging is, it's basically investing in the market every week or every month or however often it is, no matter what the stock market is doing. It basically ensures that you buy all the way down, catch every single dip that you could ever catch, and also catch every rally that ever happens in the stock market. Because the risk of not being in the stock market when those rallies are happening is massive for your long-term returns. Number 8 is an unbalanced asset allocation. Now, it sounds like a lot of big, complicated words, but essentially what I'm saying here is that most new investors end up with a very tech-heavy portfolio, and that's simply because that's where most of the hype stocks tend to sit. The only problem here is that this leaves people exposed to the volatility associated with that particular market sector. And this is something that few beginner investors, let alone completely new investors, can stomach. So essentially just aim to balance your portfolio over multiple market sectors. Number 7 is one I see all the time and it drives me crazy, and it's using chart history to help you pick stocks. I've seen new investors look at the 1 year, 3 year and 5 year chart for a stock to help them determine if it's worth buying. And what often happens is they see a stock that's had a good run for maybe a year, 6 months or 2 years, and they want to jump in on it on the assumption that that rally is going to keep on going. And that is often, if not most often, not the case. To get around this, you need to be looking at the underlying fundamentals of each business. For example, revenue, profit, sales growth, performance versus competitors in the same market, the performance of the management team, and many other factors that you need to consider to determine if you think that stock is going to continue growing or if its growth phase is over, etc., etc. If you're not doing this, you might as well just go to the casino because your odds are probably just as low. Number 6 is a lack of patience. Successful long-term investing is about 1% picking stocks and about 99% just waiting and not listening to your emotions while they scream at you to make you do the wrong thing. The bottom line is the more you mess with your portfolio, the worse your returns are likely to be. So again, concentrate less on price action and more on the underlying fundamentals of the business. In fact, Fidelity did a study of the best performing accounts held by their customers, and here's what they found. The best returns held by everyone who had an account with them belonged to two types of people. The first group were people who completely forgot that they even had an account. They had invested decades ago and just left it to do its thing. The second group were accounts that belonged to people who were dead because they couldn't mess around with their portfolio. This is the true story, guys. Number 5 is waiting to get even. Now this is a really hard one because it's about overcoming your own psychology. This means you are waiting to sell a stock until it comes back to the point at which you can sell it to break even. Now this is actually referred to as cognitive error. Basically, you're being an idiot. Because in your brain, you're thinking, oh, well, I just need to wait until it returns to the price at which I bought it at, whether that's in the next month or the next year or 2 or 5, and then I'll sell it and then at least I've not realized a loss. What you don't realize is you're actually losing out twice. Firstly, by holding a losing stock that's sliding, probably for a good reason. And secondly, being unable to redeploy the capital that's in that losing stock into a position that might actually grow. And again, you'll hear me bang on about this a lot, but this is why you need to understand the fundamentals of the underlying business, because if those fundamentals break down, then you know that it's time to sell that stock and redeploy the capital elsewhere. Guys, just sell it and move on. Number 4 is an interesting one, and it's incorrect investment style selection, because you need to find a method that is going to respect your risk tolerance, your objectives, and your resources. Unfortunately, one size does not fit all when it comes to investing. Far from it. Therefore, it would obviously be stupid to pursue an investment style that doesn't actually fit your goals, risk appetite, and time horizon. And this is why I'm not a huge fan of copy trading that you can do via popular platforms, because you never know if that person's strategy is one day going to completely change because of changes to their personal circumstances that you couldn't predict. And they've got no obligation to update you about those changes. And therefore, you could end up stuck in the dark, not knowing why they're making these decisions, and they could suddenly start losing loads of money. Number 3 is probably one of the most common mistakes that people make, and it is relying on emotions. When it comes to the stock market, I've coined the phrase that pragmatism pays. Ultimately, if you can't wait just a couple of days to either buy or sell a stock, then the likelihood is that you're probably acting on emotion without even realizing it. You don't need to rush your investment decisions. And ultimately, the fewer feelings you involve in your investing decisions, the better, i.e. pragmatism. Number 2 happens all the time. I'm guilty of this. Every investor is guilty of this, and that is falling in love with a stock. This is particularly rife all over social media and on YouTube. But guys, there is a clear difference between adding to a stock that has great underlying fundamentals and therefore the stock has gone up, and adding to a stock that's gone up just because you like it. Always refer to the strength and the growth of that business and not your feelings. And last but not least, the biggest one of all that I see is they over diversify. Now don't get me wrong, diversification is a great way to mitigate risk in your portfolio. But having a portfolio of 25 plus stocks as a retail investor is just stupid. This is what I like to call diversification, which is a term I stole from Peter Lynch, but I'm sure he won't mind. Ultimately, you cannot keep up with that many businesses in your portfolio, and you'll end up with more losers dragging the value of your portfolio down. I would personally say to stick to around 10 companies or less if you can, because for each individual company that you invest in, you need to be reading at least the quarterly reports and any one-off press releases. So that's a minimum of 4 reports per stock per year. So if you've got 10 stocks, that's 40 reports every single year that you need to be reading. That's nearly one a week. This is why index funds and ETFs are the best option for 99.9% of investors who don't have the time to read all of that on top of their job their family, their hobbies, and everything else you've got going on in your life. Plus the fact that you're unlikely to beat the index as it is, so why put in all that extra time? One thing you need to accept at the end of the day, guys, is you won't always get it right with investing. If you think you will, then you shouldn't be investing, because I promise you, you won't. No one does. Humans are emotional creatures, and we act on these emotions in the choices we make every single day, often without even realizing it. However, with the right resources and education and knowledge, and ultimately doing your research, you can overcome these emotions and actually win and succeed and build wealth long term in the stock market. I actually have a free investing guide and a bunch of other completely free and really helpful, useful resources inside my free community, the Wealth Kickstarter. I will leave the link to that below in the description, so go check that out. Thank you guys for watching all the way to the end. If you found this video helpful, which I also really hope you have, then please don't forget to smash the thumbs up button. Please go and do that right now. That would really help me out. Also, don't forget to subscribe for more on how to manage and invest your money to become financially free. In addition to that, make sure you comment below if you've got any questions about this, or if you've got anything you would add to this list as well. Until the next one, take care, guys.